Hello, I'm Moira O'Neill for focusIR. I'm here today with Jamie Constable, Market Strategist at Singer Capital Markets. Jamie, welcome. We're here today to talk about your new report on inflation and interest rates, which is fascinating. So both have been at the forefront of the conversation around markets since the start of this year. So let's start with inflation. There's a massive spike, basically. What's going on here?
Very much what we're putting forward here is that it is very much spikes. It spiked up and then it will spike down. And we've really split that into three spikes to really just keep the picture on what's happening. The first spike we're talking about is producer prices. Producer prices screamed up during the pandemic. Why was that? Well, we had a classic supply chain shock to the global economy. Everything shut down. Then the Western world all started up at the same time, while you had a lot of the Asian markets, of course, the suppliers, China, etc., supply the goods. They remained in various stages of lockdown. So we saw prices hit extreme levels. Post that, we then had Ukraine as well. So that added to that supply chain shock as well.
So your report mentions lags in how inflation moves through the system. Can you explain what's happening there?
Yeah, so producer prices are right at the start of the whole process. So when we look at producer prices now, it might be surprising to some, we're now seeing deflation. So deflation in China, deflation in the US, deflation in UK, and deflation in Europe. And that means that prices are now falling year on year. It's not just that the rate of inflation is falling, i.e. the increase, the actual prices are falling. So that would be right at the forefront of the process, good prices. Then there's a lag in how that moves to consumer prices, which is our second spike. Spike 2 would be consumer prices, CPI, as you've heard about. Consumer prices are now falling as well. So China is in deflation, in consumer price inflation. Okay, the US is back to 3 and a little bit %. Europe's coming back down. UK lagging, but it's clear that inflation is falling in the UK there. So goods feed into consumer prices, and there's a lag there as well.
So it sounds like you're more relaxed about the outlook for inflation now. Do you think there's going to be a new normal in future? What could that look like?
Yeah, we are more relaxed about inflation now. I mean, there's a lot of talk about wages. Wages are our third spike. Wages still look quite messy, but if you look at the US, wages are now, the rate of increase is falling. And if you look at unemployment is now picking up in the UK and it's picking up in the States. So they're the longest lags that we just talked about. So the longest lag is wages. And people have talked about have wages driven up prices. It's been none of that at all. It's been prices leading wages. So that means we're more relaxed about inflation coming down now. And that very much because the longest lag being those wages. Wages aren't a good indicator, but unemployment is now rising. Vacancies are rising as well now. So that's why we can be more relaxed about inflation looking forward. Your question about the new normal, there's a lot of different influences on inflation at the moment. If you think about decarbonizing the world, that's inflationary. You think about the removal of free money, and we made a lot about it. Free money is over now. If you look at interest rates, we're 5% plus across UK, Europe, the US, Europe, UK and US, not quite at 5 yet in Europe. That period of free money, which is an exceptional period of 13 years, has very much come to an end, and you can see that in bond yields. So our argument on inflation, that with that free money going, you can see insurance rates as well going up. A lot of free money drove down the rates there. Rising healthcare costs, that inflation could actually level out at a higher level now. Could it be 2%? We think that it could be too painful for global economies to push inflation down to 2%. We think maybe around 3%. And you've seen a bit of comments of this in the press of late, that 3% could be the new 2%.
And 2%, of course, has been the target set by the Bank of England for years and years and years. So we could be setting higher targets and have to get used to a little bit more of a price increase every year. Really interesting. So moving on to interest rates, which have risen steeply, of course, since December 2021, which has been absolutely brilliant for savers and terrible for those with mortgages. But this actually follows a really exceptional period of 13 years when we had those zero rates, which you've mentioned earlier in your mention of free money, which was the zero interest rates. Are we going to end up in a period of normalisation after this exceptional period? What's happening?
That's very much our argument. Yeah, we've had this period of exceptionalism. It was needed post the 2008, 2009 financial crisis. Rates were cut to near zero. QE was introduced. We argue that what the central banks forgot to do in the mid-2010s was they got to take away the medicine, as it were. Some people have called it the heroin of free money. They forgot to take that away. But getting to take that away, we then hit the pandemic and they doubled up. I mean, US did actually raise rates. The UK, we cut rates because of Brexit, so we were on rock bottom. So QE was increased and we had that whole period of more money. Now we're having to remove that medicine of free money. And that has many impacts across the world. So yes, we had that period of 13 years odd of exceptionalism. Now we move back to normalization. And if you look back at the long-term charts, if you go back to the 70s, if you go even further back than that, interest rates have been at much higher levels. So we argue that, yes, you're not going to see that unless we're completely wrong inflation, and we don't believe we are. You're not going to see interest rates go back down to those virtual zero levels. But we do argue that very much now interest rates should have peaked. 5%, 5.5% should be the peak because we're seeing the impact of those rises in interest rates. And the point you made earlier about lags, the lags of those interest rate rises now coming through and impacted on markets and financial markets.
I think a lot of people will be relieved to hear what you're saying. But your report also looks at something really fascinating called the wealth effect, which is, I understand it, is where your savings income is actually rising faster than mortgage costs. What is that? Why is that important for the economy?
It's very important, this, and I think it's something that's been missed and there's not been a lot talked about on this. If you think about that period of 13 years of zero interest rates, people got no return on their savings. People have lots of savings, different parts of the economy, different demographics, savings or had savings. They were receiving zero from having that money in the bank. Interest rates have now moved up, so we're over 5%. If you now look, you can get virtually 5% on an easy access cash account now. If you buy low coupon gilts, you can get 5% virtually, short dated low coupon gilts, you can get 5% virtually tax free because, of course, the return is all in the return of the 100 of the gilt when you get the money back, and that's capital gains tax free. So when we look at the net consumer, and by that we mean if you add up all the consumers in the UK and you look at all of their savings and then you calculate how much return they're getting on their savings, and then on the other side of the equation, you've got everyone with mortgages. So there's and there's been a lot about this, the increased cost of mortgages. Of course, they're going up. They've gone from rates in the 1s to rates in the 5s, even the 6s now, 6%. But if you net off that increased cost of mortgage interest payments and repayment mortgage payments against the increased return on savings, the consumer is £10 billion per month better off. And then we look forward on that data and see when does that fade? When does that 10 billion disappear? It doesn't disappear until at least 2025. So that partly explains, I think, when you've seen companies like Next say you've had wage rises come through as well, don't forget, and you've had wage rises as well. The consumer is actually in a better state than they were, and people are now getting returns on their savings. And not much has been said about this excess money that's now there to be spent in the economy.
We're not very good at reporting on good news, are we? But I think a lot of people will be either feeling the pain or celebrating when they see what their bank accounts can get them. I think, obviously interest rates are used as a tool essentially to control inflation. But I understand you think that the Bank of England has made a bit of a mistake with them. Why is that?
Well, I think they forgot to front load the interest rate rises. I mean, if you look at the US, they started raising later than the UK, but they went straight in with big 0.5% plus interest rate rises. We started with 10 basis points and then gradually brought through. And then we, at the end of the interest rate rising process, we started using larger rate rises. So I think that was the big mistake. We kind of tried to start raising rates, but didn't, and then delayed. Then we started with small increments and then brought in large increments at the end. And that partly, I think, explains why, if you look at the charts, inflation spiked higher in the UK than it has done elsewhere. Also, partly as well, because we do import a lot of the goods that we use, 80% in food, for example. But rates have now reached the point where they should stop raising rates. If you look at as I just talked about, employment, which is the longest lag indicator there is out there, unemployment is starting to rise. So they need to stop. You have the lagged impact of those rate rises coming through. The lags are longer than ever because, of course, fixed rate mortgages, 2-year, 5-year fixed rate mortgages, it takes longer for those interest rate increases to have an impact on the economy. So now's the time to stop raising rates, let the lagged impact come through, and let the economy adjust. And as CPI falls, which it is, then CPI falls, the consumers should then become more confident. So spending per se doesn't cause inflation is the important point to make here. Spending more than there is supply, which we had with this supply spike, yes, that can cause inflation, but supply isn't a problem now. Supply of goods is not a problem. So spending on its own is what grows the economy.
Yeah. I think that's all very good news, and hopefully the Bank of England follows what you say. But I think, CPI, that's the core measure of inflation, consumer prices index inflation. When is that going to move below base rate? I think that's the critical point to which everyone's going to start feeling good again. How fast will it happen?
Yeah, well, we think by the end of the year that will happen. If you look at CPI and the base rate, which is basically not the interest rate, you have the base effect. So last year in October, we had a 200 basis point, 2% increase in inflation. That will drop out of the number come this October. You've got another energy price fall to drop out. Not as large as the last one. It's about 9% this time. But again, that will help as well. Now, on the contra side, we have got fuel prices. Petrol prices have gone up a bit of late. So talk about spiky. You might get a mini spike back up in September. But we'll just see that as a little bit of noise on the way down. So we very much see CPI be below base rate by the end of this year. And as that happens, it then becomes very hard, really, for the Bank of England to argue that they should be raising rates, in our view. That very much they need to stop. And as we move into 2024, start to be thinking then, because you've still got the lagged effect of those mortgage rate increases coming through as people come off their 2-year and 5-year fixes. They should even then start to be thinking about rate cuts.
Yeah. So anyway, that all sounds very positive. It's fascinating to hear your insights, Jamie, and thank you very much for sharing them with focusIR.
Thank you very much. Thank you.